This bond auction should have failed, and that's exactly the problem. Last week, the US Treasury sold hundreds of billions in new debt. On paper, it was a success. Demand looked strong. Yields stayed contained. Headlines moved on. But if you look closer, this auction made no sense. Because at these yields, in this environment, with this level of debt, buyers should have walked away. Inflation is still sticky, deficits are exploding, debt issuance is accelerating, not slowing. And foreign demand? It's been quietly falling for years. So who stepped in? Here's the part nobody is talking about. Primary dealers were forced to absorb the supply, not because they wanted to, but because they had to. Banks, dealers, balance sheets already stretched, taking on risk they don't want, at prices that don't compensate them. That's not a healthy market. That's a market being propped up. And history tells us something important here. Before markets break, they don't collapse immediately. First, they stop sending honest signals. Auctions don't fail, they're rescued. Prices don't crash, they're managed. Volatility doesn't spike. It goes suspiciously quiet. This is exactly what happened before 2008. Exactly what happened before the UK gilt crisis. Exactly what happens when confidence is replaced by control. Because a failed auction would have been honest, painful but honest. It would have forced repricing. It would have forced reality. Instead, the system chose stability over truth. And that choice always comes with a cost. The problem isn't that the auction cleared. The problem is it needed help to do so. Because once markets realize prices are no longer real, liquidity disappears. And when liquidity disappears, things don't unwind slowly. They snap. This doesn't mean collapse tomorrow, it means fragility today. And fragility is invisible until it isn't. Watch the auctions, not the headlines, because the day one of them does fail, it won't come with a warning.